Bloomberg Audio Studios. Podcasts, radio, news.
This is the Bloomberg Daybreak Europe podcast, available every morning on Apple, Spotify, or wherever you listen. It's Thursday, the 10th of April in London. I'm Stephen Carroll. Coming up today, just hours after coming into force, Trump announces a 90-day pause on higher tariffs for dozens of countries. The US president offers no reprieve for China, imposing even higher levies that now total 125%. Plus, Liberation Day for markets. The S&P 500 gains almost 10% as the tariff pause drives the best stock rally since 2008. Let's start with a roundup of our top stories. Donald Trump has announced a surprise 90-day pause on higher tariffs that hit dozens of trading partners while raising duties on China to 125%. The president also says he's going to take a look at tariff exemptions for some US companies and will decide, quote, on instinct. It all comes 13 hours after the extra duties on 56 countries and the European Union took effect. Trump was asked why he decided to back off.
I thought that people were jumping a little bit out of line. They were getting yippy, They were getting a little bit yippy, a little bit afraid.
President Trump speaking there as the White House confirmed that with the exception of China, countries hit with higher duties will now face a 10% baseline levy instead. US tariffs on steel, aluminium and automobiles remain at their current rates alongside separate tariffs on Canadian and Mexican goods. Bloomberg has learned that China's top leaders are meeting today to discuss additional economic stimulus in response to the latest tariff salvo. On Wednesday, Trump further escalated the tariff battle between the world's two largest economies. A 125% tariff on Chinese goods took effect at 5 a.m. London time. The move follows Beijing's announcement that it will raise its tariffs on US products to 84%. Despite the rising tensions, the US president expects the two countries to begin negotiations over trade.
China wants to make a deal. They just don't know how quite to go about it. It's one of those things they don't know how quite. They're proud people. And President Xi's a proud man. I know him very well. And they don't know quite how to go about it, but they'll figure it out. They're in the process of figuring it out, but they want to make a deal.
Trump says he doesn't believe he'll need to raise rates any further to bring China to the negotiating table. Despite the latest escalation between Washington and Beijing, markets are viewing Trump's tariff reprieve for other countries as a major positive. The S&P 500 soared on the news, regaining more than 70% of the losses since the so-called Liberation Day announcement last week. In all, more than 30 billion shares worth $1.5 trillion changed hands across US stock venues, a level of activity not seen since 2008. But some, including TPW Investment Management CEO Jay Pawlowski, believe the damage has already been done.
This has been an immense own goal by the U.S. administration. We have basically proven ourselves to be not good partners, not good business partners. And I think that was reflected in the Treasury market and reflected in the dollar. And so for us, we have been and continue to be of the view that we are early in a secular change of leadership away from U.S. equities, which have been the leader since the bottom in 2009, to the rest of the world.
Jay Pawlowski speaking there as Asian stocks are on course for their biggest jump in 2 years, while European stock futures are pointing to significant gains at the open. Meanwhile, the yield on two-year treasuries jumped by as much as 30 basis points on the tariff pause, some calling it a no-win market. There have been fears about the stability of the world's biggest debt market and its status as a safe haven. Donald Trump acknowledged he had been watching the moves.
I was watching the bond market. The bond market is very tricky. I was watching it, but if you look at it now, it's beautiful. President's
action caused a major reversal of the curve steepening trade as traders unwound bets on swift interest rate cuts. The S&P 500 ended yesterday 9.5% up, its biggest one-day gain since 2008. It took just minutes to reverse much of the past week's losses. Bloomberg's James Wilcock has the story.
Is it real? That was how traders on the New York Stock Exchange reacted as word spread of Trump's U-turn. The news sparked a stunning relief rally as trillions of dollars moved into equities in minutes. Goldman Sachs reversed their forecast for a US recession, which they'd published only 2 hours before. But even as the rush hit, worry remains. Some investors who spoke to Bloomberg say it's still hard to form a fundamental view of what the Trump administration actually wants. In their view, the volatility is by no means over. In London, James Woolcock, Bloomberg Radio.
And there's a new warning: the UK housing market risks being blown off course by the US trade war. The Royal Institution of Chartered Surveyors' measure of buyer demand hit its lowest since September 2023 last month, with activity expected to dip further in the next 3 months. Their index of house prices dropped by 9 percentage points to well below the median expectation of economists. While the outlook for next year is more positive, Rix warns that this could change if the turmoil unleashed by Trump's tariff salvo escalates. Those are your top stories on the markets. The MSCI Asia Pacific Index up 5.2%, on track for its biggest jump in more than 2 years. The Nikkei in Tokyo is 8.5% higher. European stock futures pointing to a strong open in Europe. Euro Stoxx 50 up 8.1%. FTSE 100 futures 5.5% stronger. DAX futures up by almost 8% as well. On Treasury markets, the 10-year yield down another 5 basis points this morning to 4.29%. The 30-year yield down 5 basis points as well to 4.69%. On currency markets, the Bloomberg Dollar Spot Index is 0.4 weaker. The euro is trading at 109.83 against the dollar. The pound is at 128.59. Well, in a moment, we'll bring you up to date on all of the latest tariff headlines, plus dig into the major rally that we're seeing on markets as a result. But we have a great read on Bloomberg this morning, detailing the inside story of Trump's tariff reversal. Justin Sink and his team writing that within 14 hours, Trump executed one of the biggest economic policy reversals in modern presidential history. The piece has some fascinating insights: how Trump was watching the bond markets, how he placed particular weight on commentary from JP Morgan's Jamie Dimon, who had said it was perfectly reasonable to conclude that global trade was unfair, but also warned that a recession was the likely outcome of Trump's moves and that businesses were cutting back amid the uncertainty. That's a message that seems to have gotten through to the US president. Donald Trump also tempted by the overtures that he'd had from trading partners looking for deals after the tariffs were mooted, apparently offering concessions on issues like non-trade barriers that hadn't been in play before. The social media post itself with the announcement, drafted by Trump, Howard Lutnick and Scott Bessent, without any of Trump's legal team present. In fact, some people in the White House only found out about it at the same time as everyone else. Meanwhile, Trump's trade chief, Jemison Greer, was testifying before Congress as all of this was happening. Here he is being questioned by the Democratic representative, Stephen Horsford.
How many days? How many weeks?
I understand it's 90 days. I haven't spoken to the president since I've been in this
So the trade representative hasn't spoken to the president of the United States about a global reordering of trade.
Yes, I have. I've just been in the hearing with you, sir.
But yet he announced it on a tweet? WTF? Who's in charge?
The president of the United States is in charge.
That's Trade Representative Jemison Greer there, giving you an insight of perhaps how quickly this story was changing. You can read Justin Sink's full account of how the decision came about on Bloomberg.com and on the terminal. Well, the higher tariffs have been paused for many countries, including members of the European Union, but China still facing this massive levy now of 125%. Let's bring in our senior US government editor, Derek Wallbank, for more on this story. Derek, the focus, of course, now on very much what's happening between the US and China. How much more escalation could we be in line for?
Well, we've gotten signals that this is as high as the U.S. wants to go, but never say never, right? Because the original rate for this was going to be 34% on top of the 24, or on top of the 20 that had already been levied, right? So somewhere in that 54 range. But then there was an additional 50, and now that's been plussed up and we're at 125. So we really have to say a bit of never say never, even though the initial read is this is as high as we're going with China. The latest moves sort of put us into a place where from here forward, you are looking at a very sort of bifurcated trade posture from the United States, right? You have a massive 125% tariff on all Chinese goods. And let's be clear, the U.S. is defining China as not just the mainland, but also Hong Kong and Macau. And then for the rest of the world, generally speaking, there are a couple of here and there's, generally speaking, a global 10% minimum. So that is a very, very different world that you're talking about here. Were something like that to hold, you can see a clear case where the move toward trying to get supply chains to move from China to other countries, your Vietnams, et cetera, is very much still in play.
And of course, this opens the door then for negotiations that these countries, many countries we've been told, have made overtures to the White House to try and get concessions in that process. Are they going to be encouraged, even though, as you point out, many of these countries are facing the 10% baseline levy still? Are they going to be encouraged by this move to perhaps make more attractive offers to the US president?
Well, the last time that you and I talked, we talked about how no country had figured out how to move the president off of his signature economic policy. And now we've gotten an indication, because what we said at that time was, when you first get that move, that's going to sort of give clarity about how to do it in future. Now, I'm not sure that the exact way that that's happened is exactly clarity, but one of the things that the White House did make clear that I think everyone's going to be paying attention to is that there's a difference between China, which very stridently responded, and a lot of the other countries which didn't. Right? We had been mentioning a lot of these countries were in wait and see posture, didn't necessarily immediately retaliate. Some of that was because they wanted to do talks instead and were racing to Washington to try and do that. Some of it, candidly, the European Union's a great example of this. They were still talking about what they wanted to do, even as they were being pushed by some, France and Germany, to respond harder. The events sort of completed a cycle before they got to it. In any case, that kind of wait out wound up being a strategy that resulted in lower tariffs for people. And as I say, we're at very early days in a 4-year administration, but everyone is taking notes about how to move this president.
The other story, the other next step in this story we're watching as well is our reporting that China's top leaders are preparing their own economic response to this as well, and the potential for more stimulus to counter the effects of the trade war. What do we know about the options they're considering?
Well, that's exactly right. We're understanding that top leaders are meant to meet today to discuss additional stimulus items. You're talking about support measures for consumer spending, technology, housing, things of that nature. So it's a lot of kind of domestic support is kind of where we're hearing for China. That would track with a lot of what China has been trying to do, sort of broader in their economic strategy over the last several years. You know, one of the things that we've seen is that some flagship companies really do have an ex-US strategy. BYD, Huawei are great examples of this. They don't really have any US presence to speak of, but they've still managed to find an awful lot of success. And so this would be an example of China sort of doubling down on itself. An analogy I have heard is that a river may be quite turbulent, but the ocean is a great leveler, right? And all water flows into the ocean. China's economy is an ocean to itself.
Derek Wellbank, our senior US government editor, thank you very much for joining us as we are watching for further developments on this story. Well, Trump's announcement sparked a dramatic reversal on market. Stocks on Wall Street soared, the Nasdaq having its best day in 24 years. Treasuries rallying too. Asian shares are higher. Futures pointing to a jump at the open in Europe as well. Let's bring in our Markets Live strategist, Mary Nicola, for more. Mary, how should we be thinking about this turnaround on markets? Is this a full reversal of the recent sell-offs, or is it investors jumping on any good news?
I think it's probably more of the latter, that we're just jumping on any good news, because the fact is that tariffs they're less punitive, yes, but there is still some concern over a recession of some kind, and sure, inflation has abated, but it still doesn't completely erase a lot of the global growth woes that have really gripped the markets to begin with. We still have tariffs that are in place, and they're at historically high levels, and then, of course, you have tensions between the world's largest economies still elevated. So a substantial bounce may be harder to come by, and we're likely to see that over the coming days.
We also had the story that Derek Bullbank was just telling us about the potential for China's stimulus as a response to perhaps the damage from this. Of course, China very much being punished by the increase in levies that have now come into force on its imports as well. How are markets parsing this bad news and potentially good news from stimulus?
Yeah, what we've seen this morning is that China assets are just essentially ignoring these punitive levies from the U.S. And what the focus has been on is just on stimulus. So obviously, as tensions rise, there's higher expectations of more stimulus. You noted the news of that policymakers are meeting. And so, of course, that is all putting hopes that more is coming sooner rather than later. And then, of course, we had the disappointment from the price data this morning, which essentially highlights that there is a need for more stimulus, even when you're ignoring what is happening on the external side, because the domestic challenges are still quite strong. So you still have deflation, you have a property malaise, and you have weak consumption. And what's happening externally just compounds it.
How is this all playing out on the Chinese yuan? Because it's something we've been watching very closely, how the People's Bank of China has been managing its daily fix for the currency.
Yeah, the yuan, essentially, we saw that the fix was weakened today, and we're going to see a gradual weakening in the currency. There had been recent calls that we would get a sharper depreciation in the currency, but that's unlikely, especially with the market volatility, especially with how high the dollar CNY volatility remains. And of course, the prospects of triggering outflows is still a threat if you decide to make such a one-off depreciation. And of course, you don't want to, when you're under the spotlight like China is right now, you don't want to draw the attention and be a bad actor in this environment. So I think China is going to continue to play by the rules in the sense of not doing anything aggressive on currency policy to ensure that it has its credibility.
Mary, this time yesterday, a lot of the focus was on the moves that we were seeing in treasury markets, this massive jump, particularly at the long end and curve in yields. A reversal of that, as we've seen rallies across treasuries as well as equities on the back of this. Can we say that treasury markets have returned to normal now? Are they vulnerable to further shifts in policy?
I wouldn't know about normal, but I think you do get reprieve, absolutely. So normalcy might be a little bit far-fetched, especially when you look at where volatility stands. So if you look at the MOVE index still remains very elevated. So obviously there's still a lot of jitters in the bond market. But one thing is interesting, and it does seem that it's the bond market that caused Trump to blink rather than the stock market. But of course, the erratic moves that we saw just prompted him to shift gears. And so, but what we're seeing overall is that if with the delay in these tariffs, we are going to see a delay and a more wait and see approach from the Fed, that still keeps yields elevated. But overall, I think also you still have discussions on the tax cuts coming through and a tax bill that's still in the pipeline. So I wouldn't say that we're out of the woods completely on the bond market.
This is Bloomberg Daybreak Europe, your morning brief on the stories making news from London to Wall Street and beyond.
Look for us on your podcast feed every morning on Apple, Spotify and anywhere else you get your podcasts.
You can also listen live each morning on London DAB Radio, the Bloomberg Business app and Bloomberg.com.
Our flagship New York station is also available on your Amazon Alexa devices. Just say, Alexa, play Bloomberg 1130. I'm Caroline Hepker.
And I'm Stephen Carroll. Join us again tomorrow morning for all the news you need to start your day, right here on Bloomberg Daybreak Europe.